I think that inflationary pressures do seem to be on track to last well into the middle of next year. And if they last longer than that, then I'll just say that our policy will continue to adapt. We're at a place where unemployment is now very low, historically low, and inflation is well above target, and the economy no longer needs this very highly accommodative stance of policy. And I would expect that this year, 2022, will be a year in which we take steps toward normalization. That will involve raising.
And it's anybody's guess how many, Rebecca. The word is either 3 to 4 rate hikes this year. Is the market underestimating the risk associated with this transition to tightening?
You know, Maria, I don't see how you can't say that it is. It's like, it reminds me of, I hate to give this analogy, but it reminds me of a roller coaster when you're still going up, but you know what's coming when you get to the top and you're going straight down. And I hate to say that, but let's be clear, $120 billion a month. That's the stimulus that we've been used to, plus absolutely next to zero low interest rates. So you're talking about 3 to 4 rate hikes, according to Goldman and all the prognosticators. But also, you're talking about them running off their balance sheet. So we're not just talking about cutting back stimulus, but we're also talking about them potentially shedding the balance sheet to the clip of $90 billion eventually a month. So this is a huge swing in the opposite direction. The market has, let's be clear, the market has been very used to accommodative helicopter money since 2009, too big to fail. We've gotten used to this as being our go-to, and it's backed us into a corner. And I would not want to be Powell for anything in the world right now, because he has got the most delicate balance to strike, and it's not going to happen. The market is not going to react positively, and it shocks me that it's not preparing for what's inevitable.
Yeah, I mean, look, we've got all of this inflation already, Joel, and businesses are likely going to be talking about this when they report earnings. That earnings period begins this week. We will also get the consumer price index this morning at 8:30 a.m. What are you expecting in terms of the inflation story, and how do you invest around it?
Well, I mean, we're going to have probably, eye-popping numbers, 7% plus. Year over year, it's going to be 7% plus. We're taking off a low number from last year and injecting a new number, so that's higher. So we're going to see these eye-popping numbers for a while, the highest we've seen in 4 decades. In terms of investing, I mean, what's interesting is that yesterday, after Fed Chairman Powell spoke, I mean, the highest growth stocks with the lowest earnings and big losses were the ones that soared yesterday, and today already pre-market, the market is up again, anticipating this news. So it's really kind of puzzling to a lot of investors. Why is the market responding this way? And so the best way, I think, to position it, particularly with earnings coming out, as you say, later this week, is to position companies that have steady growth. I mean, this is a good market for slow and steady. So steady growth, profit, cash flow, and consistently, beating expectations. And so we're going to see, high flyers, soaring and plummeting. We're going to see other stocks, some value stocks will do okay in this market. But I think that slow and steady is probably the best way to position your investments in this market.
Well, I mean, look, Keith, yesterday, J.P. Morgan Chairman and CEO Jamie Dimon told me that the bank is going to do well in a growing economy. Higher rates are obviously good for the banks. But he also said that the economy can handle higher interest rates. You like J.P. Morgan as a stock, saying that they understand real money. What do you mean by that?
Well, Jamie Dimon is unquestionably one of the smartest executives ever to show the face of the banking community. I think he really understands this. JP Morgan is conservatively positioned. They've got a blend between old-fashioned merchant banking and consumer banking. So they are very balanced coming into a situation like this. They do make money from expanding rates. They've got a great book of business that expands worldwide. They're building a digital bank. I mean, they're firing on all cylinders. So when you come into a rising rate environment, he is absolutely correct. The economy is strong. It can stand higher rates, particularly if you are going to companies that make great stuff at the top of their industry and they're at the leaderboard. That, to me, is exactly where you focus right now, and for the reasons, same thing.
Keith, real quick, what about tech right now? That is the area that seems to get crushed every time we see this nervousness play out on Wall Street over the Fed's move.
Well, it's a great irony because people are worried about the Fed, right, which is talking about 7, 8, 9% inflation. Many of these tech names are going at 35, 40, 50%. So if you're really seriously worried about tech or about inflation, that's exactly where you want to be because they're the companies growing and changing our world. JP Morgan doesn't get to grow without tech. Pfizer doesn't get to grow without tech. Apple, Microsoft, lots of these companies are powering what they're doing.
Okay, we will leave it there. Great to see everybody this morning. Thank you so much. Rebecca Walser, Keith Fitzgerald, thank you so much. Joel Schulman, you're sticking around with us all morning. We're happy about that. Thank you, everybody. Quick break.